there's been an enormous amount of information provided both by the RBA and the Bureau of Statistics in the last 2 days. There have been 2 statements by the Government Reserve Bank, Mr. Philip Lowe, PhD. The first one was his statement on the 6th of June, in which he announced that the cash rate would rise by 25 basis points to 4.1%. Our scenario remains that that won't be the last rate hike, but we think there'll be another one in July, another one in August. It'll peak in September at 485 basis points. In doing his statement on the 6th of June, the Governor noted that services in price inflation is still very high and proving to very persistent, both here and overseas. And he said that unit labour costs are also rising briskly, with productivity growth remaining subdued. And that last statement is very much emphasised by what happens with productivity and unit labour costs in the GDP numbers that were released the following day. GDP on a quarterly basis in the September quarter, GDP per hour worked, which is the measure of productivity, in the September quarter fell by 1.4%. It then followed that up with a fall in GDP per hour work, a fall in productivity in the December quarter of 0.3%. And that meant that for the full year to March 2023, GDP per hour worked, that is to say productivity in the Australian workforce, fell by 4.6%. Now that's scary bad. If you're looking at productivity numbers and you're hoping that growth in productivity is going to rescue us from inflation. And as the result of that decline in productivity, what we're seeing is the increases of real unit labour costs, which rose which are a combination of 2 things. One, they're a combination of wage increases, and they're an increase in productivity. And we're only at the beginning of a series of rapid rises in wages. So already the increases in wages that we've seen increase real unit labour costs through the year by 1%. So the cost of producing things was worsened by declining productivity, but that's in a situation where increase in wages was only beginning to happen. And the problem is that that wage growth is what we're seeing is likely to accelerate. The only way you can actually sustain an economy like this from going into a significant recession is if you've got a very good, you're receiving extremely good prices for what you're selling to other countries. And fortunately, Australia is really lucky to be in that situation. One of the charts that I'll show with the video of this presentation is Australian export prices in Australian dollar terms. And what you'll see is that they are indeed the highest that have ever been achieved in the record. But what we just show is the highest, is the record since 1990. And what we find is that in the previous cycle, which is peaked only a few months ago, Australian export prices were around 8 times the level that they were at the end of last century, and they were 70% higher than they were in the previous resources boom. Now they've declined, but they're still, those commodity prices are still 40% higher than they were in the previous resources boom. So that's the only thing which saves us from having a really bad experience in the next couple of years with this low productivity. Which brings me to the intriguing question, which I was only asked this morning on the way when I was walking in here. And that is, do I think that rates will peak at 485 basis points? And I said, yes, I think so. But why I remark upon that is I've been looking at our record versus the Federal Reserve. And one of the things that Mr. Philip Lowe, PhD, noted yesterday in his speech called The Narrow Path is that our rates are still lower than international rates. And so I looked at the probability that we would actually peak at a lower rate than the Federal Reserve. And I found that since 1990, when the Australian cash rate has been created, the chances of us peaking with the peak rate below the Fed funds rate is exactly 50%. Because there have been 4 tightening cycles since 1990. And those tightening cycles were in 1995, 2000, 2008 and 2019. What's interesting to note, however, that in the circumstances where rates finished lower than the Fed funds rate at the peak, the government of the day was a coalition government. That is to say, the government in 2000 and 2019 were both coalition governments. In the 2 examples where rates finished higher than the Fed funds rate, the government of the day, the first government of the day was Paul Keating, and the second government was Kevin 07. So the record shows that, yes, it is possible for rates to peak at a lower level than the Federal Reserve. But so far, that hasn't been achieved by a Labor government. So this will be the great challenge that we'll see forward that it's issued to Australian politics. And I'll leave you with that thought.